Hello, welcome to CDH's YouTube channel. My name is Ko Fujimoto. I am going to talk about the US exit tax and possibly the easiest way to understand. I did make one illustration for you, so hopefully it clicks in your mind. Who gets taxed, how to get taxed, and when you file your tax returns. So let's get started. If you're a US citizen, if you're a US citizen, or if you are certain green card holder. Certain green card holder in this slide is long-term resident. If you hold your green card for 8 years or more, you are long-term resident. If you only own green card, or in other words, if you're a green card holder even for 1 day in a year, that year count as 1 year. So if you look back 15 years and that green card holder years becomes 8 years or more, you are long-term resident, okay? Now, US citizen or green card holder, long-term resident, for whatever reason you want to give up your status, US citizen, renounce your US citizenship. Green card holder, abandon your green card status. Well, I don't know the reasons, but if you do, US tax system, the exit tax system, will put you, go through, you don't have to physically take the test, but there are 3 tests that you need to go through. One is net worth test, number 2 is tax compliance test, number 3 is income tax liability test. I have one more slide to explain this testing, but let me give you just very quick picture of each test. Net worth test, you hold more than $2 million in assets, you may be subject to the exit tax. If you fail to declare you have been following the federal income tax rules for the last 5 years, you may be subject to the exit tax. And if your federal income tax liability exceeds a certain amount on average for the last 5 years, then you may be subject to the US exit tax. These are the 3 tests. If you meet or not really meet, let's say if you fail one of these tests, then you become covered expatriates. Covered expatriates may be subject to the US exit tax. If you do, if you clear all 3, then you will never get taxed with the exit tax. Okay. Then assume you become a covered expatriate, then there is a system of US exit tax. 3 ways that you may get taxed. Number 1 is mark to market. Number 2 is 30% withholding. Number 3 is ordinary income tax. Again, I'll give you a very short snapshot. Mark to market is IRS wants to tax you unrealized capital gain of your worldwide asset while unrealized gain you earned while you are US resident. Okay, you haven't sold your asset, stock, real estate, investment, you haven't sold them, but you have a gain built in. Don't worry, IRS will give you a break. 2023, $821,000 is the exclusion in aggregate. So your total gain, as long as it doesn't exceed $821,000, for 2023. There is no mark-to-market tax. Get relieved. All right, number 2 is 30% withholding. This applies to, again, certain your deferred compensation account. What is a deferred compensation account? Good example is 401k, traditional 401k account, U.S. employer based, or U.S. employer based pension system. You receive certain amount for the rest of the year for the services that you provide in the past. So that's your deferred compensation. Now, if the employer is a U.S. employer and if you file certain form, now I use certain too many times, I know, but in this case it's a W8CE. W8CE on a timely basis, then you get to use this withholding tax system. If you want to take the money out, you get only 70% of it. 30% will go to the IRS. Depending on which country you reside, depending on if your home country has an income tax treaty, you may be able to get the entire money. But this is the withholding tax system. You don't pay taxes when you abandon your status. The last one is the worst one. If you have traditional IRA and you don't, liquidate them, you haven't really take the money out, but IRS will tax you the entire amount as if you liquidate the entire balance. This is a worst case scenario. The other worst case scenario is ineligible deferred compensation. In connection with number 2, if the employer is not a U.S. employer and they don't want to submit 30% to the IRS, unfortunately that gets to the category number 3. Don't worry, the deferred compensation subject to the exit tax only applies only to the money earned while you are a U.S. resident. So before you become a U.S. resident, you earn some deferred compensation with the foreign employer. They don't get taxed. But it must be a part of your net worth test, the $2 million test. Okay, so obviously, you give up your status, you renounce your citizenship. Let's say 2023, you don't pay taxes in 2023. You pay taxes on 2024 with the tax return. Tax returns are, number 1, Form 1040 NOR, dual status. Let me say that one more time. Form 1040 NOR, non-resident, / dual status. Why dual status? Because you have 2 status in 1 year. You have been a tax resident of the United States until you give up your status, and after that you become a U.S. tax non-resident. Because you have 2 status, you must file 1040 NOR dual status. There is no married filing joint returns for this form. Therefore, each spouse must file 1040 NOR dual status return. Getting back to net worth test, the test does not apply to a couple. It applies to an individual, one spouse separately. Okay, if one spouse net asset exceeds 2 million, he or she is going to be a covered expatriate. Okay. In addition to 1040 NOR dual status, you must file Form 8854 Initial and Annual Statement of Expatriation. Initial and Annual Statement of Expatriation. Because of this name, you can guess. A certain covered expatriate must submit this Form 8854 every year until the balance gets zero. Okay. So the 1040 NOR contains the Form 8854, but separately you need to send 8854 only to a different address of IRS. So I think this is a hard copy filing. You gotta make sure that you are meeting this obligation, because I think the penalty of not filing 8854 is $10,000. And of course you need to make a payment. All right. So the three tests, let me spend a few more minutes to explain in more details about those three tests. The net worth test, $2 million and over. Number one, the real estate must be valued at fair market value when you give up your green card or when you renounce your citizenship. It's a fair market value. The IRS says that you can use a good faith estimate, but when you get audited, you need to make sure you can defend your position. Cash, foreign currency cash, US dollars, doesn't really matter, you need to include them. 401k, pension values, you need to somehow come up with your value of your pension, present value. Life insurance, your cash, maybe a cash value or the value of your life insurance policy. Living trust asset, you still control the assets in a living trust, therefore it has to be included in this $2 million test. Obviously there are ways to move your assets away from this test. That's beyond the scope of this video, so I'm not going to explain. But if you plan to give up your green card in future, you need to contact professionals like us probably 3-4 years before you actually give up, because it's a long time planning process. Okay, the 5-year compliance test, and this is critical. This is critical. Can you declare you were compliant for the last 5 years before the year of expiration? If you give up your green card or if you renounce your U.S. citizenship in 2023, you must start from 2022 and 5 years. And they ask you, have you been following U.S. federal tax rules correctly? If you cannot declare yes I did or yes you did, then you become a covered expatriate. Typical examples of failure to follow the U.S. tax rules is fail to file foreign bank account reporting, 2, grossly reported foreign financial assets in FBAR or Form 8938, failed to report gifts or bequest or inheritance over $100,000 in a year before in a Form 3520, or if you hold the stocks of a foreign corporation of 10% or more, and you didn't report them. And then others, I'm not gonna keep going, keep on and on and on, but These are the three typical examples of non-compliance of federal income tax. And also, obviously, you did not report certain income, especially in a grossly wrong tax return. You cannot declare that you have been in compliance with the tax law. Now, typically, the statute of limitation is 3 years, but in this case, you need to cover 5 years. 5 years, not 3, 5 years. Okay. So, if you know you did not follow certain rule in the last 5 years, there is a way to cure it. And contact your CPA firm or attorney to fix your problem before you file your final tax return with 8854. Number 3 is a hard test to prevent or hard test to get away. 5-year federal income tax liability test, 2023, the average amount is $190,000. If 2023, if you look back, as you can see in this table, if your average tax liability becomes $200,000, then you are covered expatriate. Now, married filing joint, can you split the liability by half? No. Actually, each spouse must pick up the entire amount of tax liability and calculate the 5-year average. So, and this test is very hard because the numbers are already there. So your choice may be to simply wait until your actual 5-year average becomes less than the amount. The $190,000 is for 2023. With the inflation, the number changes each year. So this is the 3 different tests of U.S. exit tax. Now, I can go on and explain the how the mark-to-market tax works and more details on 30% withholding or taxation onto a traditional IRA account, but this video gets a little too long, so maybe I will do it next time. So thank you very much for watching. This was actually a hard video to produce because rules are complex, and rules are complex and it's hard to summarize. Hard to summarize at the same time I can't mislead you. So I'm not covering every single point. Please take this disclaimer very seriously. And this is a cross-border ending note. Thank you very much. Have a wonderful day. And watch for the next video about exit tax. Take care.